All right, ladies and gentlemen, let's go ahead and get started. I want to try to finish this section on monetary policy goals and rules today. The plan is to do a couple of practice problems together of the type that you might see on your next lab assignment and certainly on your next exam. And then we've got a little bit more material in the slides to cover in lecture. So with that said, let's go ahead and get started. The first thing I want to do right off the top is work through this practice exercise together that will kind of test your understanding of what we covered in the last class. So just to jog your memory here, we started talking about the broader macroeconomic objectives that the Federal Reserve has, how they are embodied by this thing called the dual mandate, right? Where the dual mandate specifies that the Fed is charged with trying to maintain price stability on the one hand and maximum sustainable employment or potential output on the other. Most of the time, those two sides of the mandate are consistent with one another. However, from time to time, the Fed finds itself in situations where it has to trade off one goal for the other, right? That sometimes price stability has to be traded off or compromised with obtaining full employment. One way that we can think about the Fed kind of charting a middle ground between its two sides of the dual mandate is by examining how different policies perform in the economy according to an objective function, right? And the objective function that we developed for the central bank in the last class was this thing called a loss function, which hopefully you remember was essentially just the sum of the squared values of the output gap and the inflation gap over time, where there might be a differential weighting of inflation gaps to output gaps depending on how we specify the loss function. All right, so evaluating the loss function is how we can kind of rank, or how a central banker can rank alternative policies. Okay, so the first example that I want to go through together today is to show an example of how we do that. All right, so here is a pretty straightforward illustration. Let's consider two different monetary policies. And each of these policies is going to generate a different set of outcomes. So you can think about them as two different settings for the federal funds rate or for the Fed's interest rate policy. Policy A is going to generate outcomes for output and inflation in these following 3 years. So we're looking at a 3-year period. Now you'll notice that potential output doesn't depend on either of these two monetary policies. Why? Because most economists think that potential output is something that's kind of beyond the scope that central bankers can actually influence with their policy. All right, that we can affect the actual level of output and inflation, but not potential output. All right. What I want you guys to do is assume that the inflation target is 1% instead of 2%. All right. And the weight omega in the Fed's loss function is equal to 1. So the Fed here is equally weighting inflation gaps and output gaps in its loss function. All right. I want you guys to tell me which is going to be the better policy, policy A or policy B. So evaluate these two policies using the same loss function criteria. The second part of the problem asks you to do the same analysis, but this time change omega to 1/2. Meaning what? That inflation gaps are no longer penalize loss as much as output gaps, right? So output gap stability is the more important objective for the central bank in that example. I think in the interest of time, we should just go ahead and do this one together, all right? So here on the next slide, I've basically reproduced the stuff from the previous slide, so the stuff from this table, okay? But I've left space in the new table for you guys to calculate the output gap and the inflation gap for each of these two policies over all 3 years. All right. So let's start with the output gap. How do we compute the output gap, let's say, for year 1 under policy A? Remember how we define the output gap. It's the percentage difference of actual output from potential. So it's going to be what? It's going to be 1,060, that's actual output, minus potential output in year 1, 1,050 divided by potential output times 100% gives us 0.95%. So the output gap under policy A in year 1 is going to be 0.95%. Now, I'm not going to do these calculations for every one of them. I'm just going to put in what the numbers actually are, and I'll let you guys go back and practice these on your own. But what you're going to find is that if you plug these numbers into your formula for the output gap, you'll find that the output gap goes from 0.95 to 1.59 to 1.07% under policy A, and it's negative 2.38, negative 2.49 to negative 0.66% under policy B. So it looks to me like policy B is more of the contractionary policy, whereas policy A is expansionary, right? Policy A is a loose or accommodative stance of monetary policy compared to choice B, which is a tighter or less accommodative stance. Okay, we're halfway there. How do we calculate the inflation gap? Well, that's super easy to do, right? That's just actual inflation minus target inflation. So what is the inflation gap, for instance, for policy A in year 1? Well, it's just 2% actual inflation minus the inflation target of 1% gives us an inflation gap then of 1%. We apply that formula for all 3 years across both policies, and we get a history of inflation gaps here from 1 to 2 to 2.5%. This is the expansionary policy. So inflation is rising above target. Here is the contractionary policy. The inflation gap goes from 1% and it starts to go towards 0. Okay, now how do we evaluate which of these two policies is preferable for the central bank? Well, what you want to do is you want to plug in these output gap and inflation gap values directly into the central bank's loss function. Remember, this is essentially like the utility function for the Federal Reserve. That's how we determine which of these two policies, A or B, is the better one, whichever one generates lower central bank loss. Well, what would loss under policy A look like? All right, now this is easy to do, but you can make careless mistakes, so be very careful about this. Loss under policy A, remember, it's a quadratic loss function, so it's just the output gap, 0.95 squared, plus 1 times the inflation gap squared, where remember the weight, omega, is 1 in part A. So that's the squared output gap and inflation gaps from the first year. You add to that the squares of the output gaps and inflation gaps in the subsequent years. Now, if you do the tedious calculations there and add all of that up, you're going to find that central bank loss for policy A is 15.83. Okay? Loss under policy B ends up being 14.11. Now again, just to be clear, that would be an output gap of negative 2.38 squared plus 1 times the inflation gap of 1% squared. That's year 1. Plus year 2 would be negative 2.49 squared plus 1 times 0.75 squared. All right? We're just plugging in the inflation gap and output gap numbers directly into the loss function from the previous slide, which is just the squared values of the output and inflation gaps summed up over time. So, which of these two policy choices is the Fed going to want to implement or pursue? The contractionary policy B or the expansionary policy A? Policy B results in lower economic loss. So policy B is the superior choice. And believe it or not, this is actually how a lot of central bankers think, okay? They have some idea about what the overall macroeconomic objectives are. They have a lot of different options for the setting of the federal funds rate or the path of the federal funds rate. They plug those numbers into their own kind of internal forecasting models, which are giant models of the macroeconomy, and they use them to compute loss across different policy regimes. The one that is the lowest is the most desirable path of the interest rate. So this kind of gives you a sense about how many central bankers think about optimal monetary policy. Straightforward? Okay. How does the answer change if we change the weight on inflation stability to 1/2? So now inflation gaps aren't going to penalize the loss function as much as output gaps. It stands to reason then that the contractionary policy might be worse than the expansionary policy in this case. But to determine that with any certainty, you've got to plug the numbers back into the loss function. So what is loss A? Well, loss of policy A, again, it's just plug these output gap and inflation gap numbers back into the loss function, but this time make sure that the weight on the inflation gap is 1/2 rather than 1, and you'll find that it's equal to 10.2. The loss under policy B is 13.21. So now policy A generates a lower value of economic loss or cost to society than policy B, and so policy A is superior. So you see, by changing the preferences of the central bank just a little bit in favor of stabilizing the output gap over inflation, you end up with a different optimal choice of which policy to actually pursue. Levi? That's a very good question. They don't necessarily. So you've made a great observation here that our quadratic loss function makes an implicit assumption about the symmetry of the target, right? A 1% output gap is just as painful as a negative 1% output gap if the loss function's quadratic. 3% inflation is just as bad as 1% inflation. Many economists think that the Fed's true preferences are more asymmetric, meaning that negative output gaps are more painful than positive output gaps. Positive inflation gaps are more painful than negative inflation gaps, right? When you have those type of asymmetric preferences, you have to move away from a quadratic loss function to something else. Those types of functions are a bit harder to evaluate, but they exist in the literature, right? So here, we're assuming that these preferences are symmetric around the target. That's a very good observation. Any other questions about that? Okay, so make note of how to do that. I promise you guys on your next lab, there will be some problem in this genre, okay, where you're going to be presented with different policies and you'll be asked to evaluate loss under the two policies or perhaps more than two policies. Okay, this is what I'm trying to tell you here to convey the message is that when central bankers are trying to figure out what the optimal monetary policy setting is, this is the way they organize their thinking. They have different potential policies in mind. They have some type of loss function for the economy. It may be, Levi, an asymmetric loss function. And then they have these big forecasting models of the economy. You can plug or insert these different policies into these macroeconometric models and see how they generate different values of loss. That's essentially what we're doing in a very elementary way in this class. Okay, any questions then about that? All right, so let me move on to this discussion of monetary policy rules for the rest of class today. So macroeconomists have long debated what kinds of procedures central banks should actually follow when making their policy decisions. Now, I'll tell you that our views on these issues are heavily influenced by a strong belief that people's spending decisions, as well as businesses and firms' investment and spending decisions, depend at least in part on expectations about the future. In particular, expectations about the future course of monetary policy. Let me state that one more time. That's an important point, okay? When central bankers are thinking about what procedures to adopt in setting monetary policy, they oftentimes take into account the forward-looking nature of individuals and firms in our economy, right? What we expect the Fed to do in the future is going to have a big impact on how the actual economy unfolds, and therefore should have a big impact on how the Fed actually sets monetary policy, okay? This raises, hopefully you guys see this raises kind of an obvious or a natural question, and that is it better for monetary policy to be set in a very predictable way that people in the private sector can actually forecast with a high degree of accuracy? Or is it better to allow the central bank to have much greater flexibility in responding to changes in the economy? In other words, should policy be set according to something called a fixed rule that is very predictable by the private sector? Or should monetary policy be allowed to practice what we call discretion? All right, let me spend a few minutes talking about the actual differences between what we mean as rules versus discretion. A really important subject in the study of monetary policy. A rule for monetary policy is literally a systematic setting of policy according to a formula, okay? So a kind of a classic example of a monetary policy rule would be Milton Friedman's 3% per year growth rate of the money supply, right? So for a long time, he advocated central banks adjusting its monetary base every year in order to guarantee that the money supply increased at a stable rate from one year after another. That's just one type of monetary policy rule. There are many others. There are others, for instance, that allow the central bank to adjust its federal funds rate target in a systematic way to changes in the economy, like inflation developments or unemployment. We'll talk about a specific policy rule here in the next little bit. A policy of discretion is something entirely different. Under a discretionary policy, the central bank really has the freedom to set interest rates in the best way it sees fit at each and every one of its policy meetings, okay? And the way that it sets the interest rate at these policy meetings is not to be constrained by something the Fed did in a past period or constrained by some type of systematic formula, okay? Discretion allows the central bank to adjust the interest rate as it sees fit in response to unpredictable economic events. Okay, this sets up this debate about rules versus discretion for monetary policy. Now, let me emphasize here that the Fed's institutional independence gives it the ability, gives it the authority to set monetary policy either way it wants. That is, if the Fed wants to, it can set policy according to something that looks like a rule, or the Fed can set monetary policy according to a kind of a discretionary type behavior. Now, the Fed, of course, is obligated to pursue the dual mandate, right? It's supposed to accomplish price stability and full employment. but the way it goes about accomplishing those goals is really up to the Fed. It can follow a rule, or it can follow discretion. What I want to do today, and what follows here, is I want to talk about some of the key costs and benefits of these two different policy strategies. What problems in particular can emerge under a policy of discretion, and what kinds of problems might emerge under a policy rule, all right? Okay, let me start with discretion first. So one common problem with practicing a discretionary monetary policy is that the central bank will, from time to time, find itself confronting something called an expectations trap. Okay, so what is an expectations trap? This occurs when the Fed finds itself in a situation where it has to actually increase the country's rate of inflation merely in response to a change or a jump in expected inflation. In other words, nothing fundamental has happened in the economy to actually lift prices. But if the private sector expects inflation to be higher in the future, the Fed is going, or the central bank is going to find itself in a situation where it actually has to take policy actions that increase the rate of inflation to match those expectations. That's what we mean by an expectations trap. Now, that's kind of theoretical and abstract. So let me try to provide a straightforward line of argument that can help, excuse me, rationalize how this might arise, okay? Let's suppose that for whatever reason, private investors in the economy think that at the next FOMC meeting, the Fed is going to ease monetary policy by lowering the federal funds rate, okay? Now, we all know what happens when the funds rate is lowered. That's a loosening of monetary policy, and that's likely going to set in motion a period of faster growth and higher prices, right? And so that's going to, so private investors think that because of this easy stance of monetary policy, inflation is going to go up in the near future, all right? Now, what happens as a result of that? Well, immediately, inflation expectations in the economy rise. So that pi superscript E means the private sector's expectation of future inflation. So that goes up. All right. Well, the economy is very much forward-looking. It's not backward-looking, right? When inflation expectations go up, something that's going to happen pretty quickly is that long-term nominal interest rates are going to start to creep up as well. Now, why is that? You guys remember the Fisher equation or the Fisher relationship from your intermediate macro class? The nominal rate is the real interest rate plus expected inflation. So if expected inflation goes up, all else equal, that's going to tend to raise the nominal interest rate as well, okay? Now, what's the problem with this? As nominal interest rates rise, credit conditions in the economy tighten, and as a result, the economic growth starts to slow down, correct? All right, so we have economic growth slowing down, employment and output starting to fall as a result of that. Now, the Fed wants to avoid a recession, correct? And so what does the Fed have to do in order to avert that recession? It's going to have to lower its federal funds rate target in order to try to stimulate economic growth so that the recession doesn't actually happen. All right, now let's go one step further with this. If the Fed is lowering the federal funds rate, what do we know is likely going to happen to inflation as a result of that? That's going to set in motion a period of higher prices. So inflation actually is going to go up. You see what's happened here. Merely an increase in expected inflation has caused a rise in nominal interest rates, which causes the Fed to actually try to lower its funds rate target in order to avert the recession, which ends up bringing about higher inflation anyway. So this increase in expected inflation is kind of self-fulfilling. It's what's called a self-fulfilling prophecy. It ends up leading directly to higher actual inflation because the Fed has to accommodate those higher inflation expectations in order to avoid slower economic growth or a recession. That's what an expectations trap is, okay? Now let me ask you this question. How would the Fed, if it was to implement a policy rule, be able to avoid the expectations trap? If instead policy were being set according to a fixed rule as opposed to discretion, why would this whole situation be avoided? Or how could it be avoided? Levi? Exactly, right? The reason why expected inflation went up in the first place is because policy was not being set according to a rule, right? If policy is being set according to a rule, then people have a really good idea about the course of monetary policy in the future, and the private sector is not going to incorrectly form these types of expectations. So this is one of the key advantages of rules over discretion, is that it avoids these type of expectations traps. Okay, let me turn attention now to policy rules for a second and discuss one of the key problems with trying to implement a policy rule. One that has been most noted in the literature is what's referred to as this time inconsistency problem. So policy rules are often not time consistent. Okay, now that's a phrase you probably haven't heard before. So what exactly is that? Time inconsistency results when a central bank chooses a policy at one date, and then the private sector makes decisions and plans based on an expectation of that policy playing out in the future. But once those plans of the private sector have been set and laid down, the central bank finds itself in a position to actually deviate from its earlier plan or renege on its policy promises. In other words, what is optimal today is not necessarily going to be what is optimal for the Fed to do in the future after these expectations have already been set in. In other words, the policy is not consistent over time. It's a dynamic kind of time inconsistency problem. Okay, now again, all of that is very abstract, so let me lay out an example to help try to illustrate it. Let's pretend for a moment that the Fed announces today a policy of zero inflation. So instead of a 2% inflation target, the Fed promises to keep inflation equal to zero forever. That is, it's going to fix the aggregate price level over time. Okay? Now, once that policy decision is made, the private sector is going to come around and make decisions based on that expectation, okay? Here's an example of one. Let's suppose that workers now negotiate with their employers labor contracts that are based on an expectation of zero inflation. Labor contracts last for multiple periods, right? So we need to, when we're deciding these or negotiating on these contracts, we need to think about where prices are going to go in the future. Because what we care about is our real wage, not our nominal wage, right? Okay, well, what happens next? Well, once those labor contracts are signed based on an expectation of zero inflation, the central bank, the Fed in our case, has this incentive to renege on its earlier policy promise of zero inflation, right? Let's see why. Imagine now that once labor contracts have been signed, the Fed would like to create some unanticipated inflation. So it lowers its federal funds rate target, and and prices start to go up, and so inflation starts to go higher. Okay. Now, as a result of that higher inflation, what ends up happening to the real value of those wage contracts you've signed? They start to go down, right? The real wage is the contract wage divided by the price level. So higher inflation increases the price and lowers the real wage. Well, as real wages decline, What happens to employment and output? Real labor costs of firms go down, and so businesses can hire more workers. Employment goes up, and output goes up as a result of that. So what has happened here? The Fed has been able to boost employment and output, and therefore increase economic growth by fooling the private sector, by promising to implement zero inflation, but after spending and contract decisions have been made, generating some amount of surprise inflation, okay? So what was optimal originally, zero inflation, is no longer optimal after people have made decisions based on that earlier expectation, okay? Now, people aren't stupid entirely, right? Some people are not so bright, but most of us are somewhat intelligent. We're not going to be fooled permanently by the actions of the Fed, right? We see that they've raised inflation to try to boost output. So what are we going to do with regard to our own inflation expectations in the future? We're going to revise them up. All right, the Fed didn't actually target zero inflation. They tried to trick us in generating a little bit of inflation. So our expectations of inflation rise. Well, what happens now if expected inflation goes up? The central bank is right back in one of these expectations traps, where they have to actually accommodate the higher inflation in order to avert the recession, okay? So this time inconsistency problem that can plague policy rules sometimes will lead to this kind of deviating behavior on the part of the central bank, which, if followed through, is going to immediately place the central bank back in this kind of expectations trap scenario, okay? So time inconsistency is a common problem with trying to adopt fixed monetary policy rules. Okay, questions about that so far? Does all that make sense? All right, now, establishing a fixed rule for monetary policy does not necessarily have to lead to a time inconsistency problem, okay? I don't want you guys to get the impression that following a policy rule is always going to be time inconsistent. There are ways for rules to be time consistent, but in order for that to happen, the central banker has to be credible. The Fed needs credibility in order for its policy rule to be time consistent. Okay, now what do I mean by credibility with regard to the central bank? Well, you guys know what the word credible means, right? That's when we apply it to monetary policy, that means the private sector must be able to believe that the Fed will actually follow through on its promises. A credible policy rule means that the private sector must actually believe that the Fed will always follow through on those promises. And I don't have this spelled out exactly in the slides, but the other piece of this is that the Fed, or the central bank, needs to actually honor those commitments over time, meaning that it needs to match its deeds to its words, all right? If the central bank can demonstrate that, it can attain enough credibility so that these policy rules are no longer time inconsistent. Now, there's a handful of ways that I want to talk really briefly about on how the Fed can actually gain credibility, all right? Some of these may be straightforward and obvious to you. One way that a lot of people have talked about before is to adopt a policy of strict inflation targeting. In other words, drop the dual mandate that the Fed has in favor of a loan mandate, where the Fed only really cares about stabilizing inflation. Why would this help credibility? Well, if the Fed doesn't have an output gap goal in its loss function, let's say, then there's never any temptation for the Fed to renege on its policy promise of fixing the inflation rate at its target level, right? In the previous example, what tempted the central bank to deviate from its policy promise was to generate extra economic growth through surprise inflation. Well, if it doesn't really care about stabilizing the output gap, then it's not going to have that temptation, right? So strict inflation targeting is certainly one way to gain credibility. Another is to give the central bank more independence. Why does this make sense? Well, elected officials in Congress as well as the executive branch oftentimes favor the employment output side of the mandate, right? Elected officials would like the economy to be growing robustly so that they can get reelected to office again and again. And so if a central bank has more political insulation or independence from outside parties, it can better avoid those types of temptations or resist the temptation to generate surprise economic growth or surprise inflation. Another way to gain credibility is to nominate conservative central bankers. So that's small c conservative. I don't mean Republican versus Democrat central bankers. What I mean by a conservative central banker is one that essentially places a larger relative weight on stabilizing inflation compared to the output gap, right? If we appointed central bankers that have an omega in their loss function that's a high number, then they're going to care more about inflation relative to the employment side of the mandate. That's going to send a strong signal to the private sector that the Fed is very serious about maintaining price stability. Another way that the Fed can gain credibility, I think probably the most important way, is just reputation, right? Credibility can be gained by establishing a good reputation over time, right? If the Fed demonstrates, for example, its adherence to some policy rule over many months and many years, then it's probably not going to be trying to fool or trick the private sector in a way that would generate this kind of surprise inflation. And it's going to be more likely that policy behavior and rules will be believed by the private sector. The last one I'll just mention briefly is commitment to a fixed policy rule. There are some central banks that have certain institutional arrangements that tie their hands in a legal way to adopt policies in a particular way. So, for example, you might have heard of certain central banks are formal inflation targeting central banks, like the Bank of Australia or the Bank of New Zealand, the Bank of Israel, the Bank of England, are all formal inflation targeting central banks, okay? There are some central banks around the world that adopt a fixed exchange rate regime. In that case, the policymakers have basically tied their hands to implement monetary policy in a particular institutionalized way, regardless of what happens in their economy. All right, so if there is a legal commitment to some type of fixed policy rule, like inflation targeting, then that's one way for the central bank to gain credibility. The Fed does not actually have it's not a strict inflation targeting central bank. It does not actually have to commit to that type of policy rule, but over time, the Fed has gained a great deal of credibility by maintaining a high reputation, demonstrating that it can adhere to good policies over time. Okay, you guys have any questions then about that? Do you understand the difference between discretion versus rules, the expectations trap versus time inconsistency, and how some of these ideas here can help the central bank generate the credibility needed to overcome the time inconsistency problem? Alrighty, let me move to the last topic now. So I think one thing about the Fed's operating procedure that has been very clear now for at least the past 25 years or so is that at least under normal circumstances, the Fed uses the federal funds rate target as its chief operating instrument, right? The Fed wants to change monetary policy. It moves the federal funds rate up or down. But how does the Fed actually make a decision about what level the funds rate target is supposed to be? Right now, it's between 0 and 0.25%. 20 years ago, it was much higher. How does it make those decisions about what actual numerical value the federal funds rate target should actually be? We know that it adjusts the funds rate in order to satisfy or accomplish the dual mandate. The Fed is supposed to maintain price stability and full employment. But does the Fed actually follow something that could be described as a monetary policy rule? Or does it behave in a way that's more similar to a discretionary central bank? If the answer is a rule, and I think there's good reasons to think that it is, or at least something that resembles a policy rule, then we need to think about what that rule actually looks like. A lot of research has been conducted in the past 20 or 30 years that shows indeed the Federal Reserve and many central banks around the world probably have a lot of rule-like behavior. They make decisions that can be well approximated with some type of monetary policy rule. And that a lot of times those rules lead to better economic outcomes than would a discretionary type policy, all right? Now, we all know that when it comes to the Federal Reserve, these FOMC deliberations, when they're deciding on what value they want to set their federal funds rate target at, are very complicated deliberations. Many factors are incorporated into these discussions, okay? The meetings take all day. Sometimes they span over 2 days. In a very famous research paper that was published in the early 90s, macroeconomist John Taylor was able to show that he could actually summarize all of these many factors that get accounted for in these FOMC meetings by using what he called a simple rule for monetary policy. This rule has become so ubiquitous in monetary economics that it goes today by the name of the Taylor Rule, after economist John Taylor. You can find it in academic papers. You can find it in policy papers. You can even see it referenced in policy speeches and in the financial media as well when they're talking about Fed and central bank decisions, okay? Now, the beauty of the Taylor Rule was that John Taylor was actually able to demonstrate two things. One, that the Taylor Rule did a really good job of explaining the actual path of the federal funds rate over the period that he was observing, which at the time was like mid-80s to early 90s. And probably even more important was that the Taylor Rule, when plugged into a larger model of the economy, generated really good macroeconomic outcomes in terms of low and stable inflation and robust economic growth. So it satisfied both sides of the dual mandate in the long run. I want to talk about the Taylor Rule today, and then go through some examples of how it can be used in practice. Okay, it's a very, very influential monetary policy rule that's used all over the world. Okay, the Taylor Rule has four. I don't know if you've seen this. Maybe you touched on the Taylor Rule a bit in your intermediate macro class, but we're going to get into the details of it today. The Taylor Rule has basically four key ingredients. The first one is the most complicated. The last three are pretty easy to understand. First is an estimate of something called the equilibrium real federal funds rate. Now, what is that? Well, the real federal funds rate is just the nominal funds rate minus the rate of inflation, right? That's the real federal funds rate. But what is the equilibrium real funds rate? That's what the real funds rate would be equal to if output was equal to potential in the long run. So the equilibrium real funds rate is not a variable that we actually observe in the real world. That's why we have to form an estimate of it. Taylor proposed a particular estimate of the equilibrium real federal funds rate. Okay, it's the real interest rate that is consistent with output being equal to potential and inflation being equal to target in the long run. What are the other three ingredients of the Taylor rule? Well, the second one is just the current rate of inflation over the last 12 months. We know what we have observations on that. And then we also need to know what the output gap is currently, as well as the inflation gap. So how much does output deviate from potential, and how much does inflation deviate from target? Those four pieces of information are sufficient to write down the Taylor rule. And here's what the Taylor rule is. The Taylor rule is basically a prescription for how monetary policy actually is and should be set by the Federal Reserve, that kind of simplifies all of the complicated factors that go into the policy making process. So what John Taylor argued was that the federal funds rate target should be equal to the equilibrium funds rate plus the current inflation rate plus 1/2 times the output gap plus 1/2 times the inflation gap. Or simply, the funds rate target, IFF star, is equal to R star, that's the equilibrium real funds rate, plus pi, plus 1/2 times Y tilde, the output gap, plus 1/2 times pi tilde, the inflation gap. Now, in his paper, Taylor assumed that the equilibrium real federal funds rate was 2%. That is debatable. It's probably lower than that now. And the target rate of inflation is 2%. That is not debatable, right? The Fed targets 2% inflation. We know that with certainty. Okay, I want to do a few examples of how to apply the Taylor rule. But before we do that, let me ask you guys a couple of questions about this, okay? What does the Taylor rule say the Fed should do if, let's say, inflation rises above target, all else equal? So let's say inflation rises from 2% to 3%. It goes up by 1 percentage point. All else equal, what should the Fed do to the federal funds rate according to the Taylor rule if the inflation rate rises by 1% above its target rate? Well, look on the right-hand side of the equation and you should be able to tell. What's your name again? Derek. Okay, go ahead. It's going to go up, right? So policy should be tightened, but exactly how much? If the inflation rate, let's say, rises by 1 percentage point, then we know here that the funds rate is 1/2 times the inflation gap. So that tells us that the federal funds rate target should go up by 50 basis points. But Derek, be careful. Inflation also appears here in the Taylor rule. So a 1% rise in inflation raises the funds rate target by 1% there. So 1% plus 0.5% would be a 1.5% increase in the funds rate target. So all else equal, the Taylor rule says that if inflation goes up by 1%, the federal funds rate should go up by 1.5%. Higher funds rate is a contractionary policy that will hopefully bring inflation back down to target, right? That's a lean against the wind type policy, okay? What about the output gap? What if all else equal, output falls 1 percentage point below potential? So no change in inflation. Let's just say it's a negative output gap. We go from 0 to negative 1%. What should the federal funds rate do in this case? Fall by 0.5 percentage point, okay? And why does that make sense? Because if the output gap is falling, the Fed wants to stimulate the economy to bring output back up closer to target. So you see what this monetary policy rule does. It allows for the central bank to respond to changes in inflation and the output gap over time, but in a systematic way. As inflation rises, the policy rate should increase in a contractionary manner. As the output gap falls, the policy rate should fall in an expansionary manner. If there's tension between the inflation rate and the output gap, they're moving in opposite directions, then the funds rate whether or not the funds rate rises or falls can be found by plugging in the numbers directly into the formula, right? And we can see how the Fed kind of charts a middle course between price stability and potential output. Okay, let's go through a couple of examples together, all right? I want you guys to tell me, how should the Fed set its funds rate target if current inflation equals 2% and output is exactly equal to potential? Assuming R star is 2% and the target inflation rate is 2%. Well, just plug the numbers directly into the Taylor rule. It's straightforward, right? The funds rate target is R star 2% plus current inflation of 2% plus 1/2 times the output gap. Well, I'm saying here that output equals potential, so there's no output gap. And inflation is also equal to target, so there's no inflation gap. So if inflation is equal to target and output is equal to potential, the Taylor rule says that the funds rate target should be exactly 4%. This is what we refer to as a neutral stance of monetary policy. And let me be clear by what I mean by that. We say that the stance of monetary policy is neutral if the real federal funds rate is exactly equal to the equilibrium real funds rate, R star, okay? In this example here, what is the real funds rate equal to? It's the nominal funds rate of 4% minus the 2% inflation rate. So the real funds rate, that is IFF minus pi, just happens to be equal to the equilibrium real funds rate. So the stance of monetary policy then is neutral. And that makes sense, right? Because remember what the equilibrium real funds rate is. It's the value of the real federal funds rate when inflation is equal to target and output is equal to potential. How should the Fed set its funds rate target if current inflation is 4% and output is equal to potential? As long as you know what the Taylor rule says, you can literally plug these numbers into the right-hand side of the equation and figure this out. The Taylor rule says that the funds rate target should be R star of 2% plus current inflation of 4% plus 1/2 times the output gap of 0% plus 1/2 times the inflation gap, which in this case is 2%, because inflation is 4% compared to a 2% inflation target. You add up those numbers and you'll see that the funds rate target is 7%. So the Taylor rule is suggesting or recommending that the Fed raise the funds rate to 7%. This is a tight or a restrictive monetary policy stance. Why is that? Because the real federal funds rate exceeds the equilibrium real funds rate. The nominal funds rate, 7%, minus inflation of 4%, gives us a real federal funds rate of 3%. That is bigger than the equilibrium real federal funds rate. In that case, the stance of monetary policy is said to be tight or restrictive, according to the Taylor rule. Okay, how are we doing so far? All right. One more. I'm going to drill this into your brains. How should the Fed set its funds rate target when current inflation is 2%, but output is 3 percentage points below potential output? Funds rate target is R star of 2% plus current inflation of 2% plus 1/2 times an output gap of negative 3% plus 1/2 times an inflation gap of 0%, giving us a 2.5% funds rate target. This, you might imagine, is an easy policy, a loose or accommodative stance of monetary policy. Why? Because the real federal funds rate, which is the nominal rate, 2.5%, minus inflation of 2%, so that's 0.5% for the real funds rate, is less than the equilibrium real funds rate of 2%. You guys have questions about that? Again, let me reemphasize this. Why the Taylor rule is actually important for the study of monetary policy is because of two things. And I'll show you this on the next slide, but the Taylor rule does a pretty good job of approximating the actual behavior of the Federal Reserve and many other central banks over time. So it is a good positive description of how central banks actually behave, giving us a lot of evidence that policymakers do try to implement rule-like behavior. The other reason why the Taylor rule is important, though, and I think it may be even more important, is that the recommendations of a rule like the Taylor rule often lead to very good economic performance as measured by a loss function, in the sense that it can help stabilize both prices and inflation and employment and output. All right, so it's a good description of how policy is set, and it's a good prescription for how policy should be set in a lot of circumstances. Not always, but in many. Okay, let's look at some data for a couple of minutes. I think this is interesting. So here's a graph from the Fred website. I've got a small typo here. The red line here is, I'm sorry, wait a minute, is this wrong or right? Yeah, so the red line in this graph is the actual effective federal funds rate. That's the rate that the central bank, the Federal Reserve, implemented over time between 1955 and 2020, okay? The blue line on this picture is the federal funds rate that would have prevailed if, in retrospect, the Fed had actually implemented the Taylor rule in a systematic, formalized way, okay? And you can compute that by using the formula tool on the Fred website, right? So you'll notice here that basically I've got, let's see, 2, that's the equilibrium real rate, plus the GDP deflator measure of inflation, plus 1/2 times the inflation gap, plus 1/2 times my definition of the output gap. So you can construct this counterfactual data directly in Fred, okay? In the description here, I've got the colors reversed, so don't get confused by that. It's the red line is the actual funds rate. The blue line here is the rate that would be suggested by the Taylor rule, okay? Now, let me point out a couple of things here. Hopefully, one thing that you notice just by kind of casually glancing at this picture is that the Taylor rule does a reasonably good job of describing the broad contours of monetary policy over the long run, okay? It captures the rising federal funds rate in the 60s and 70s, the declining funds rate thereafter, okay? The fit of the two lines is not perfect. There are episodes where they depart, but there are periods where they're really close together, right? For instance, this period between the late 80s and the early 90s, that was the period that John Taylor actually focused on in his paper. The period right before the financial crisis and during the crisis, it was almost perfect overlap between the two. But you'll notice that there are periods where the funds rate and the Taylor rule depart quite considerably. All right, let me draw your attention to the mid-70s. What was happening during the mid-70s? The actual federal funds rate was several percentage points below what the Taylor rule would have recommended in real time. 2, 3, even 4, 5% in some cases. A lot of macroeconomists actually argue now that the rising inflation of the 1970s was exacerbated by Federal Reserve policy that was too accommodative or too loose, that the federal funds rate was significantly lower than what the Taylor rule had prescribed. So if the Fed during the 70s had actually implemented John Taylor's rule that wasn't invented until 1992, they would have been able to stabilize the path of inflation much better. We wouldn't have had double-digit inflation in the late 70s and early 80s. Another period where they depart significantly is in the early to mid 80s. Notice that the exact opposite happens during the early part of the 80s. The actual funds rate is quite a bit higher than the funds rate prescribed by the Taylor rule. Many economists argue that the severe economic recession of 1983 would not have been as severe if the Fed actually lowered interest rates more rapidly after the 1970s inflation. All right? So they attribute this as a policy mistake in retrospect as well. Let me draw your attention to one more episode that's maybe more relevant for younger folks. Look at the period leading up to the financial crisis. What do you notice going on there? The actual federal funds rate was quite a bit lower than the funds rate that was recommended by the Taylor rule. Many policymakers and pundits argue that the Fed is partially to blame for the real estate bubble that led to the financial crisis because they kept interest rates too low for too long, that the Fed was too accommodative during the middle part of the 2000s than what the Taylor rule would have recommended. If the Fed had followed a Taylor rule earlier, interest rates would have gone higher and we wouldn't have seen this big real estate bubble, the housing and the subsequent housing market crash. Okay? So this is one way to kind of ahistorically or counterfactually determine whether or not the Fed made past policy mistakes is by comparing the actual funds rate to what would have been implemented had the Fed followed a Taylor rule. One more thing that it just occurred to me. Look at even in more recent years. So after the financial crisis and even the first part of the COVID-19 crisis / recession, what is the Taylor rule recommending for the funds rate during those two periods? A negative setting for the funds rate. That is not possible, right? Notice that the actual funds rate has this zero lower bound to it. So it's not uncommon for the Taylor rule to be prescribing a negative value for the interest rate. That's not something that is feasible for the Federal Reserve to do right now, okay? Later on in the semester, and actually in the coming couple of weeks, we're going to develop something called a new Keynesian model that we can use that has in it a Taylor rule as one of the key equations, okay? And one of the things we'll do, because I think it's really relevant for modern monetary policy, is what happens if we constrain the Taylor rule to have this, what's called a zero lower bound, where the interest rate actually can't fall below zero. Well, when you account for the zero lower bound, that leads to a lot of problems in trying to stabilize the macroeconomy through something like a Taylor rule. And we'll analyze that specifically or explicitly through the lens of this new Keynesian model, okay? So make sure you really understand what a Taylor rule is, because in the next section in the course, the Taylor rule itself, or a slightly simplified version of it, is going to be one of the key features or ingredients of that new Keynesian model. Okay, any questions then about that? So I've got about 10 minutes left, and there's time to do one last exercise. This one, of course, is on an application of the Taylor rule. Just like the loss function question that we did at the beginning of class today, you are very likely to see an application of the Taylor rule on your lab and your next exam, okay? So make a note of this and come back and make sure you really understand this concept, all right? Let's suppose that I give you the following information. Real GDP is running 3% below potential. The Fed sets policy according to a standard Taylor rule, according to the formula that we just talked about. The inflation rate over the past year was 3%. The target for the federal funds rate, that's IFF star, is currently 4%. The equilibrium funds rate is thought to be, its estimate is 2%. Can you guys figure out what the inflation target is, given that information? Part B asks something else, but let's do part A first. What is the target rate of inflation? How would we solve this problem? Well, the best place to start, in my opinion, is just to write down the Taylor rule, okay? Here it is. IFF star is equal to the equilibrium funds rate plus inflation plus 1/2 times the output gap plus 1/2 times the inflation gap. I don't like telling students to memorize things, but you might want to commit this one to memory, okay? Taylor rule will be important. All right, we can plug in the stuff that we know about directly into that formula. We know that the current funds rate target, the problem says, is 4%. The equilibrium real rate is 2%. Inflation's running at 3%. The output gap is currently negative 3%. But what we don't know is the inflation target, right? So this last portion of the Taylor rule is 1/2 times 3% minus whatever target inflation is. Well, we can still solve for the inflation target because this is a single equation now with just one unknown variable. So we can actually use the Taylor rule to solve for any of these right-hand side variables as long as we actually know what the current funds rate setting is. Just if you solve that equation, you're going to find very quickly that the inflation target is equal to 2%. Okay? Straightforward? Let me go back and read part B now. Okay? Let's suppose that a year has gone by. GDP is now 1% below potential instead of 3% below potential. And inflation was 2.5% over the year instead of 3%. So inflation has come down and the output gap has gotten closer to 0. What funds rate should the Fed now set, assuming that its inflation target is the same as part A, which is 2%? So now we know all of the information on the right-hand side of the Taylor rule, and we can figure out what the optimal funds rate setting should be. Again, just write down the Taylor rule to start with. You will make far fewer mistakes if you just start there, okay? The output gap is now negative 1%. Inflation is 2.5%. The target rate of inflation is 2%. And the real equilibrium funds rate is thought to be 2%. Plugging that information into the right-hand side gives us a target federal funds rate of 4.25%. So in part A, the funds rate target was 4%. And now the Taylor rule, given the change in the economic landscape, is calling for a federal funds rate target that is 25 basis points higher. It looks to me like it's bringing inflation, that contractionary stance of monetary policy is helping to bring inflation back down to target. Unfortunately, it's not able to bring the output gap all the way back up to 0 yet, illustrating this trade-off between inflation and output gap stability. And that is all I have to say about that. So hopefully that was clear enough. On Monday, we're going to start. So let me actually make one announcement. And I don't know if I mentioned this in the last class. So I kind of rearranged a few things. I'm actually going to add one day on the calendar to, I had originally reserved 3 days to cover this chapter or section of the course. I was able to do it in 2 because I want to add an extra day to the discussion of the new Keynesian model. That topic is going to be conceptually, I think, the most challenging thing that we talk about in the semester. So I want to go through it slowly and kind of systematically over a 2-week period. And then your next lab will cover the open economy, foreign exchange intervention stuff, the stuff on loss functions and the Taylor rule and the dual mandate, and then we'll also cover some questions on the new Keynesian model. And then I guess you're going to have another exam right after that. Okay? All right, folks, have a good weekend.